Well, even with today's pullback, my first guest says that the Dow could top 15,000 in just a few months. 15,000 on the Dow. Joining me now is Keith Springer, president of Springer Financial Advisors. Keith, when I heard that in the morning meeting, I said, no, you guys got to call him back. 15,000 in the next few months? Help me out. I mean, I'm excited, but make me believe it.
Well, it's not because things look great for the stock market for the long term, Charles. As you know, you and I see eye to eye on this market, but there's a lot of liquidity in the system. There's $15 trillion that wasn't in the system a few years ago. The Fed balance sheet's up to almost $3 trillion. ECB is at $3.5 trillion. A lot of money chasing this. They're chasing risk assets, and they're going to be pushing things higher. Earnings are probably going to be better than expected. Typically, we get that. We have a little lull before earnings, and then we have a little push towards earnings season. We got an election year. Let's face it, the fourth year in an election year cycle is positive. I think things push a little higher. People have got to be chasing. People are going to be looking for returns. But I do think it peaks this year. I think this is the best we're going to see in the next few months.
Hey, if it sparks from here to 15,000, Keith, yeah, I would think that, you'd probably get some sort of a pullback. But I'm still trying to figure out the catalyst. I don't disagree with you on any of the things you talked about. But let's talk about this liquidity, for instance. It's there. It's sitting behind the vaults at banks. When does it start to seep into Main Street to the point where you might get the sort of, move up, the parabolic move that you're describing?
Well, the parabolic move is going to happen when people start to panic. People start to feel like they've missed it, and that's what's going to happen. We're seeing the institutional traders. They always get in early. They're always at the forefront, and that's what we've seen the last year and a half. And eventually the individual is going to say, hey, I can't live with 2/10 in the bank. I mean, that's what we're doing for our clients. We like to take the mantra, invest for need, not for greed, which means get the return that you need without all the risk. There's plenty of things out there with good yields. Right. There's some bonds out there, there's preferred stocks, 8, 9, 10%. People are going to start to panic and feel like they're really missing out. And they're going to eventually want to jump in. They're going to want to be a part of this. You can't sit in the bank. You can't sit in treasuries. And, you're going to see a really sort of that parabolic move when people feel like they're going to miss out if they don't get in.
Right, sort of just a panic buying, if you will. And that dovetails with the piece I read yesterday from Goldman, the cult of the equity. And historically, when this happens, when these yields have this sort of relationship, the market typically explodes to the upside. Every morning I wake up, I look at three things: China, the Fed, and Apple. If one of those is off, I know it's going to be a tough day for the market. You've already addressed the Fed. Let's talk a little bit about China, because that's why we're under pressure this morning. Are you feeling that all of this anxiety about China's hard landing, is it overblown?
I do. We got to remember two things. One, China is essentially the world's factory. They're making things for the rest of the world. Europe is going through a slowdown and a recession. Naturally, things are going to come in. Orders are going to be lower. But the other thing, the really important thing, Charles, is they're a closed society. They release information based on the way they want to. Now, China has done a good job in raising interest rates and raising bank requirements to slow their economy down. I think it's a little overblown for the time being. I think China's probably a little stronger than what people give credit for. There's probably more room for it to grow. They eat up a quarter of the world's oil. They eat up a quarter of the world's steel and iron ore. There's a lot more room for China to grow here. I just think that, it is a little bit overblown. So I think you're right on the button there.
We'll put you in a category, China soft landing, check, you still believe. By the way, I'm in the same category with you. Let's talk about Apple and some of the other would-be leaders, because if we're going to go parabolic, there's got to be names that lead the parade. Can Apple still be that name?
Apple is going to be that name. I mean, it's another situation of what we were just talking about, panic buying. People feel, and not just people, but institutions. You got mutual funds that are so under-owned in Apple. They really feel like they've got to own it. They've got to show their clients, and they want to show it in their portfolio. Apple's going to be pushed forward. Now, Charles, you and I see eye to eye that the average person can't go out and buy Apple because they don't need all that risk. The average person just simply should be investing for yield, pick up as much income or dividends where they can, taking less risk to get the best return that they can. But,
right.
Apple's probably going to go a lot higher. And, if you're an aggressive investor or you're an institutional trader, you almost have to own it.
We've got, you brought up the issue of what people should be buying. We've got about 30 seconds left, Keith. Just give me a couple of the names that you really like a lot right here.
The thing, the whole about it is invest for need, not for greed. It's picking up dividends, yield, trying to get equity returns without equity risk. Terra Nitrogen I really like. I mentioned that before. Compass, I still like Breitberg Energy. These are yields of 8, 9, 10% that you can get some upside potential without a lot of the risk, without a lot of the downside risk. And that's really where I think people ought to be focused. I think most people take too much risk.
Keith, you know, I love having you on the show. Really appreciate it. Keith Springer of Springer Financial
Thank you, John.
Advisors. We'll see you soon.